Hi, everyone. Welcome to Tax 101 Canada and US Individual Income Tax Updates. My colleague Philip and I are really happy to be here. I understand that we have a number of people on the webinar today, so thank you very much for joining. Both Philip and I are partners in our Calgary-based office and specialize in US and Canadian cross-border tax for private clients. So our clients are primarily US citizens residing in Canada or Canadians that are moving abroad. Generally, all of our clients have a cross-border aspect to their situation. How are you doing today, Philip?
Pretty good. Still recovering from a cold. Hopefully, everyone will enjoy today's presentation.
Yeah, well, both of us are actually kind of recovering from a flu over the last couple of weeks. So, anyways, we both have our water besides us. So a few housekeeping items. As a NASBA accredited sponsor, we are able to offer continuing professional education or CPE credits for today's webinar. In order to qualify, you'll need to answer all three polling questions that will appear during the session. These will pop up at various times throughout the webinar, so please make sure you stay tuned and respond promptly to each one. We really encourage you to ask questions throughout the webinar using the Q&A function. While we may not address them immediately, we have set aside 10 to 15 minutes at the end of the session to go through as many as we can. So please ask your questions. Once the webinar ends, a short survey will automatically pop up, and we would really appreciate it if you could take a moment to complete it. Your feedback helps us improve future webinars and helps us to bring relevant, valuable content to you. Lastly, if you'd like to enable closed captioning, simply click on the live transcript button at the bottom of your Zoom window and select Show Subtitles. Okay, so today's agenda, we're going to cover some Canadian personal tax updates, US personal tax updates. Philip's going to cover that section or most of it. We'll touch on some cross-border hot topics and planning tips, and then leave you with some key takeaways. So fortunately, there hasn't been significant changes going into 2025 like there has been the last couple of years in Canada. For example, last year we had the possibility of the capital gains inclusion rate changing. And the year before we had the trust reporting rules expansion. So obviously there's a lot of changes on the US side, and there's definitely some items to be aware of on the Canadian side. So the recent proposal reduced the tax rate for the lowest personal income tax bracket from 15% to 14.5% in 2025. And that will continue to be reduced to 14% in 2026 and later years. Because this rate is also used to calculate most non-refundable tax credits for Canadian purposes, the credit rate for those claims would also decrease. And so to preserve the value of these credits, the budget also introduced a non-refundable top-up tax credit. This allows the 15% credit rate for amounts above the lowest bracket, so taxable income above $57,375 for 2025. So what this means is taxpayers with large claims, for example, tuition, medical expenses, etc., you can continue to benefit from that 15% credit on the portion that exceeds the threshold. So the top-up credit will apply from 2025 through to 2030. Next, just wanted to talk about the personal support workers tax credit. This is a temporary refundable tax credit introduced for eligible personal support workers for the next 5 years from 26 to 2030. So they're able to claim up to 5% of eligible earnings, up to a cap of $1,100 per year. This is available only in provinces without a federal wage increase agreement. So it's currently not available in provinces of BC, Newfoundland and Labrador, and the Northwest Territories because those provinces have those agreements in place. Starting for the 2026 tax year, As per the CRA websites, the CRA is introducing automatic pre-filled tax returns for eligible low-income Canadians. This helps to ensure that they are going to receive key benefits such as the GST credit, the Canadian Child Tax benefits, the disability benefits, etc. So the CRA will send an individual a copy of the information they are using to populate the return. So that will be based on T4 slips, T5 slips, etc., that the CRA automatically receives. And the taxpayers will have 90 days to review and submit any corrections to the CRA before they file the return to make sure that those individuals receive those benefits. Okay, alternative minimum tax or AMT. I like to describe this as kind of a backup tax system. This ensures that everyone pays at least a minimum amount of tax, even if you have a lot of deductions or credits. So when you file your tax return, you first calculate your tax the regular way, using all the usual deductions and credits. And then there's a second calculation using the AMT rules. And these rules allow for fewer deductions and credits, and sometimes income levels are more included, such as the stock option deduction is higher for AMT purposes, or the amount that you include in income is higher for AMT purposes, just to be clear. So AMT mostly affects people with high incomes who have larger deductions or credits. An example is somebody claiming the lifetime capital gains exemption, making big charitable donations, etc. So proposed amendments to the AMT regime for high income individuals was introduced in 2023, the 2023 federal budget, and was effective for taxation years beginning after 2023. So this really broadened the AMT base to include additional income items and limited certain deductions and credits. And this slide makes some notes on some items that were affected. So the slide shows what is the inclusion rate for regular tax versus AMT, which you can see for a lot of those items, it's quite different. So originally, the new AMT rules was going to cut the charitable donation tax credit down to a 50% inclusion rate for AMT purposes, which was a big drop from the full credit that was allowed from the pre-2024 rules. So not surprising, the charitable sector pushed back. There was a real concern that this would discourage large one-time gifts and major contributions, etc. So the government responded, and now there is an 80% of the charitable donation tax credit can also be claimed for AMT purposes. If you end up paying AMT, there is a carryover rule. So if you pay AMT in any of the last 7 years, you may be able to use that AMT as a credit against regular tax in a future year. And that can carry forward up to 7 years.
So Paula, this is kind of definitely a new tax, going to impact a lot more taxpayer than before. It would be cautious for those taxpayer that are subject to some of the change on the income inclusion on certain income. What we see is on the capital gain specifically. I mean, you mentioned it, if a taxpayer claiming a lifetime capital gain exemption, or maybe they are departing from Canada that has a large capital gain inclusion, the effective tax rate would no longer be driven by regular tax a lot of the cases, and AMT would be the one that impacting their tax liabilities. And giving that for some of the taxpayer that they no longer being a Canadian resident, not subject to Canadian tax, either for departure or disease, the 7 year carryover may not be too helpful for them. So any taxpayer that expecting a large capital gain inclusion or making a huge amount of donation, they should definitely double check the AMT to see whether that would be a factor impacting the total tax.
I agree. This is an area where doing that extra tax estimate to make sure that isn't any surprises at the end of April is really recommended. There could be, especially if you're able to do it proactively in the year before the year ends, there could be some planning opportunities there to minimize your AMT exposure.
Okay.
Okay, so there are some continuing reporting changes. I touched briefly on the trust reporting that was changed for tax years ending after December 30th, 2023. So this is an ongoing annual obligation. So most trusts are now required to file an annual T3 trust income tax and information return. And also affected trusts must complete Schedule 15. It's called the beneficial ownership information of the trust. And that form discloses detailed information about trustees, settlers, beneficiaries, and controlling persons. It's a very detailed form, and as you can appreciate, can encompass a lot of information depending on how complex the trust is and the documents are. This was a major change for us the last couple of years before the expansion rules. There were a lot of exceptions to filing a trust return. Generally, you did not have to file a trust return if the trust did not earn any income. And now the exceptions have drastically changed. And it really captures most trusts and requires them to file. For example, if you held real estate in a trust that was not rented, didn't generate any income, previously you didn't have to file a return for that, and now you do, including Schedule 15. Schedule 15, if there isn't any new information on that form, you don't have to submit it on an annual basis. So Bear Trusts, they were originally included in the trust filing expansion rules, and what qualifies as a bear trust can be very confusing and somewhat difficult to determine. You can have bear trust agreements that are well documented and a formal legal arrangement. But there are also a lot of informal bear trust agreements that was causing a lot of confusion. This could have really encompassed a lot of people having to file trust returns. So in recognition of the challenges, CRA announced administrative relief for the 2023 tax year, which we were all very excited about. And this extended to 2024 and now 2025. The underused housing tax, or UHT, this is an annual 1% tax on the ownership of vacant or underused housing in Canada by certain non-residents or non-Canadian owners. The proposed budget includes an amendment to the UHT Acts, which, if now passed into law, would remove filing and payment requirements for 2025 and future years. The filing and payment obligations would still apply for 2022 to 2024, however, and this is still proposed. It hasn't been passed yet, so we're keeping our eye on this one. We feel like it will go through, but as of right now, there is still the requirement until it gets passed.
So Paula, hopefully they do pass it much
Yes.
earlier than last time. I think we all remember the change on the bad trust reporting requirement a couple of years ago.
Yes, and even with the UHT over the years, there's been some last minute changes with the CRA or deferral of deadlines. So hopefully we avoid that for the 2026 year here that we're entering into, because that can add a lot of stress to people. So we've arrived at our first polling question. Does a Bear Trust need to file a trust tax return for 2020 for the 2025 tax year? Yes or no?
So I think the key for this question is that we are dealing with a bear trust. And then we also specifically asked for 2025 tax year. So a bear trust actually is something that could be formal or informal, written or unwritten. It covers a lot of the relationship that may be unintentional. Some of the common example that you may be including that you happen to be a joint owner of your kids, but you don't own any beneficial interest, or you be added to the land title of the house, but also at the same time you don't have any beneficial interest.
That's right. Yeah. So it isn't, yeah, it's quite confusing, especially even with bank accounts, or I know people were even taking it one step further for phone plans even or anything. Like it can get wait, oh, here's our results here.
Yeah, so 75% of audience get the question correct, that the Bear Trust does not need to file a trust return for 2025 tax year. Like Paula have suggested, that's for the tax year 2025. For any future tax year, we would have to monitor CLA in terms of any update for future tax years. Because now
Right.
the rule hasn't been finalized for the year beyond 2025 yet.
That's right. Yeah. Yeah. Good point, Philip.
So, Paula, thanks for giving us the Canadian tax update. So now I could have flipped the page onto the other side of the border, talk a little bit about the US tax update. In contrast to Canada, the US does pass a pretty significant tax reform since the President Trump take the office for the second time and have control in both house. So the One Big Beautiful Bill Act was enacted on July 4th, 2025. Some of the major change it would be that it make a lot of the previous tax act, the Tax Cut Job Act, tax change permanent. Some of those change maybe that include permanently lower the personal income tax rate from the previously 39.6% to 37%. It also make the higher standard deduction permanent now. It also eliminate miscellaneous itemized deduction with some exception for educator expense only. So most people will not get any miscellaneous deduction anymore. As part of the change, it also limited to the casualty loss only to federal or state declared disasters. So if your home just got flooded on a local area, you might not get those same casualty loss on your US tax return. And then the last but not least is also making the lifetime estate tax exemption double. That is a permanent. It also set the 2026 exemption limit to 15 million and then subject to inflation indexation for any future year. Because previously, a lot of the tax practitioner and the taxpayer worry that the exemption would be reduced back to the original limit, which is half of the current limit. And then there was a lot of rush to get any gift or estate plan put in place to utilize the double. But after the One Big Beautiful Bill Act, there was no longer a concern about the exemption being in half, which is a good news for a lot of the higher net worth individuals. As part of the One Big Beautiful Bill Act, it also introduced a lot of different new deduction and essentially making a lot of the income tax free. A couple of the big item is as part of the act, it permanently it increased the state and local tax deduction from the previously $10,000 limit to $40,000 limit for married filing jointly couples. So for U.S. tax return, you are allowed to claim any state and local tax you pay as an itemized deduction against any of your taxable income. The limit of the state and local tax would be increased 1% annually for the 5 year that is included from 2025 to 2029. It would be subject to a phase down by 30% if your adjusted gross income is higher than $500,000. So for certain high net income individual, you would not get the full benefit of the increase. But even those taxpayer, the limit would not be reduced lower than $10,000, which is the original limit. One of the key factor for, especially for our audience, is the state and local tax do not include any foreign personal and or real property tax. So if you have your home outside of the US, the property tax paid on those property would not qualify for an itemized deduction. As part of the act, it also introduced a new Schedule 1A for some of the deduction on various type of income and expenses. A couple of those items is this deduction on the overtime income and the tips income. That was part of the big campaign promise for the President Trump during the campaign time. They would be subject to a limit of 12,500 per individual or 25 for married filing jointly for overtime or $25,000 on tips per person. The both deduction would be subject to a phase out if the modified adjusted gross income is higher than $150,000 or $300,000 for a couple. Some of the requirement for those deduction include that Social Security number would be required for claiming such deduction. So for some of the taxpayer that living outside of the U.S. and having a non-U.S. spouse, but utilizing some of the election available in the code to file a joint tax return, the other spouse would not be able to qualify for this deduction. As part of this deduction, we would expect that on the U.S. employment income tax form, there would be a separate box outlining the income generating from overtime and tips. But for the 2025 tax year yet, there was still some transition period. I think that information would not be available quite ready yet. So during the transition period, the taxpayer is allowed to claim the deduction based on the pay stub information and calculating the deduction on overtime income or tips. Um, for our audience, for those taxpayers that are residing out of the U.S., we expect they should be able to qualify for the same deduction for taxpayer like U.S. person living in Canada, if they are able to generating the same information, for example, on their pay stub to identify the amount of income they generated from overtime or tips, they should be able to take the same deduction. But in real life, it does not create a significant benefit for taxpayer already residing in Canada due to the fact that Canada have a higher income tax rate. And then there was also a foreign earned income exclusion deduction already available. So this measure is mostly targeting to the mid-lower income taxpayer residing in the US mostly. Then the third item on the Schedule 1A is qualified car loan interest. A taxpayer could deduct up to $10,000 of interest on the purchase of a qualified vehicle. Um, the vehicle is supposed to be purchased in 2025 with the final assembly happen in the US. So your dealership would be providing those information to help you to determine whether the vehicle would be qualified for this deduction. And a vehicle identification number is required to claim the deduction. Similar to a lot of the other deduction that it would be subject to the same phase out if your modified gross income is higher than $100,000 or $200,000 for a couple.
Those some pretty specific requirements for the car loan interest. Hey, Philip.
Yeah, it is. I think it's part of the policy intention is they try to encourage people to purchase
British US.
vehicle that is assembled locally to kind of
Yeah.
encouraging to give them incentive to do so.
Yeah, I agree. And also, and the state and local tax increase, I know is a really welcomed increase to all those people that are living in California or the more high tax states. I know I have a few clients that were happy to see that this time.
Yeah, that was actually one of the surprises as well because in typically the Democratic state tend to have a higher tax rate. There was a debate
Mm,
whether you would include that into the final tax act. I guess he's still doing it for the whole country.
yeah, interesting.
And then next one, we're going to talk a little bit about the charitable contribution change. Similar to Canada, that charitable contribution made by U.S. person could be claimed, but instead of a credit, it would be claimed as a itemized deduction on the U.S. tax return. In the past, some of the charitable contribution could be claiming as something as non-itemized deduction. What it means is someone that chooses to claim the standard deduction, they are still allowed to claim a certain amount of additional deduction if they make any contributions. After the One Big Beautiful Bill Act, that deduction was bring back effective for the tax year starting from 2026. What we are seeing is $1,000 deduction that is allowed, or $2,000 for a couple. And any cash contribution in the U.S. would be subject to the 60% adjusted gross income limit. What it means if you in the year that you are making a significant amount of contribution, the portion that is over 60% of your adjusted gross income cannot be claimed in the same year. they would have to be carried over for future year, which you could allow to claim it against your income in the future year within the 60% adjusted gross income limit. And also part of the new change is also in 2026 and going forward, it introduced a 0.5% adjusted gross income floor. For any contribution amount lower than the 0.5%, you would be no longer able to claiming any deduction, and your contribution will be reduced by the 0.5%. And any carryover contribution would be exempted from the 0.5% floor. So if you have anything that not used, either due to the 60% or the 60% limit, or you choose to claim the standard deduction, those carryover contribution would not be subject to the floor.
So
Last but not
I'm
least,
sorry.
there was the qualified charitable distribution from a individual retirement account, an IRA, still beneficial for any taxpayer that is aged higher than 7.5, due to a couple of things that the distribution directly from the IRA to a charitable organization would not be taxable. But at the same time, you receive a deduction for that same amount. So essentially, you are taking the benefit of both of being tax-free and also claiming the deduction. And also because of the US-Canada tax treaty, Canada would follow the same tax treatment as the US, that the distribution received by a US person residing in Canada would not be taxable in Canada, same as the US. But at the same time, a donation credit would be still allowed for a Canadian resident. So getting the same double the benefit.
Same treatment on the border. I was just going to say the non-itemized deduction is nice to have back too. With the standard deduction being so high, we often ignore itemized deductions, but this is an extra $1,000 or $2,000 that people can claim this year on top of that. So that's great.
Yeah, that's mostly useful for those taxpayers residing in the US.
In the
For a
US,
lot
yeah.
of our audience that residing in Canada, the foreign tax credit usually able to offset most, if not all, the US tax payable. The deduction limit probably just changed the amount of the foreign tax credit carryover. But any deduction that we could take, taxpayers should take advantage of it and generating more foreign tax credit carryover in case in the future that you would need them.
Agreed.
And the next one is the Tax Act also introducing the new type of account called Trump account. This type of account was decided for the benefit of children born between 2025 and 2028. You notice it's such a narrow window, but it actually the same time when President Trump will be in the office. So anyone born after that time, unfortunately, you would not qualify yet unless the tax law change in the future. Um, a qualified individual could set up those accounts for their children and make an election to treat those accounts as a Trump account. Uh, Assuming they are eligible for it with their SSN, the government would put in $1,000 pilot contribution to the plan when the plan was open. And after that, like other individual could make up to $5,000 with after tax into those plans, and any investment income within the plan would be tax deferred until it's withdrawn in the future. So it actually quite flexible after the plan is open, that basically the whole family could make contribution to that plan. And also the employer could even contribute it up to 2,500 to the plan on behalf of the employee to their children's account. So the intention for this plan is try to make sure that they would start saving for the benefit of the child. I think he even makes some promise that if they keep doing it until they're age 18, they would have over $1 million investment. That's probably a bit questionable whether it would go up that high. As part of the new plan, there was restriction on contribution, so nothing could be contributed before July 4th. So we haven't seen a lot, like definitely there's no account being open yet, given that the contribution hasn't even opened yet. And as part of the Trump account, they have restricted investment choice. They only allow mutual fund or ETF that tracks a US stock index with a management fee that is, I believe, is lower than 0.01% management expense ratio. So it's supposed to be mimic or tracking the investment of SP 500 or NASDAQ. So for children that is before age 18, there was limited way of withdrawing from this account. The withdrawal generally opens up when the children reach the age of 18. Either they could take out the whole balance and being subject to tax at that time, or they could choose to roll over it into their own IRA for their future retirements. And keeping that cross-border theme in mind, that we would just question on the tax treatment in Canada. Given that this account was so new, no specific comment from the Canada Revenue Agency was made on this type of account, whether it would be subject to tax or not. But my personal guess would be, it sounds like would be a taxable account, given that it's not contributed by the children himself, and it's not a retirement plan that's specifically covered by the Canada-US tax treaty. That's also a good conservative approach to treat any of the registered account. In terms of the taxation in another country, you always expect the worst, but in case it turns out to be tax-free, that would be a bonus. So we are not quite done yet. There were still other changes with the Tax Act. So this is some minor changes that they increased the child tax credit from 2,000 to 2,200 per qualifying child with a Social Security number. For taxpayer to qualify for that child tax credit, they would have to meet the usual task that the child have to be residing more than 6 months with the taxpayer. The child have to be supported by the parents. There was some age restriction, whether it's under 18 or whether they're going to full-time school. Those would be same as before. The child tax credit would be subject to the phase out for income. If the taxpayer's income is higher than 200,000 for individual or maybe filing separate, or $400,000 if they are married filing jointly. And then it was subject to a gradual phase out. Of that 2,200 child credit, a portion of it would be refundable as well. So even though you might not owe any tax, a portion of it would be refunded to you if you qualify. And then next would be covering some other miscellaneous change. I think the first one I kind of touched on earlier, that the estate gift tax lifetime exemption would be increased to 50 million for 2026. Which also will be indexed for inflation for any future year. And then a 1099 NEC filing threshold would be increased to $2,000 in 2026. A 1099 NEC, a non-employee compensation, is required when you pay or when any U.S. corporation or U.S. individual pay any contractor or non-employee for a certain amount for service. Previously, the threshold is rather low. Now it was increased to $2,000. So if you pay your accountant less than $2,000 a year, you technically don't need to file those forms anymore. And part of that, the Tax Act, it also will pay you a lot of credit, mostly related to clean energy. That's kind of similar to President Trump's idea about focusing back on the traditional oil and gas. So they kind of move away the money spending on those clean energy credit. The last but not least, there was also the 1% excise tax on remittance for a remittance transfer provider. What it means is for a US person, if you are making a transfer for a remittance transfer provider, a MoneyGram or Western Unions with cash, money order, or certified checks, the US person would be subject to the 1% excise tax. That was previously proposed to be a much broader scale that any US person transfer money between US account non-US account would be subject to the same 1% excise tax. After going through a different opinion gathering, I think there was a bit of pushback from the bank. So now, if the US person making a transfer for a US bank or a US debit card, it would not be subject to the same 1% excise tax. It mostly restricted to cash or near cash kind of transfer. The main purpose for that is try to limit the possibility of money laundering or financing a foreign terrorist or illegal activities. So we've gone through a lot, so we get into the poll question number two. So under the updated state and local tax rule for 2025 to 2029, which statement is correct? The first one is the SALT cap increased to $40,000 or $20,000 for Mary filing separately with annual 1% indexation. The second one is the cap permanently expire after 2025.
Oh, definitely a lot more to cover on the US side this year with the new act in place, Philip. Great job. There's a lot of minor details there that definitely would affect people differently if you're residing in the US versus residing in Canada. That's always something to be very aware of. If you're a US person residing in Canada, you're generally subject to tax at your tax rate is generally the country with the higher tax rate via the foreign tax credit mechanism, etc.
Yeah, you're right, Paula. I think the Tax Act generally brings a lot of measure, but it impacts different
Mhm.
taxpayer differently. For most people residing outside of the US, the impact would not be as significant
That's
as someone that
significant,
is
right?
living in the US.
Yeah, exactly.
So we get the poll back. 94% of audience get it correctly that the correct answer is number one, that the cap would be increased to $40,000 with an annual 1% indexation from 2025 to 2029. For 2020-30 tax year, we expect it to go back to $10,000 unless any new rule or new tax rule got to change that. So that's not quite the end yet, Paula.
Couple
So
more.
as part of the new One Big Beautiful Bill Act, it also introduced new measures. This one is specifically targeting for U.S. person owning a non-U.S. corporation. That could be a that could be a controlled foreign corporation, a CFC. For some of the audience that are not familiar with it, is in the case of in the past, if you are a U.S. shareholder and you own a non-US corporation that is a CFC, you would be required to include it in your income for some of the passive income or for the active income earning the corporation to make sure that you are not deferring any tax by having those corporations outside the US. So a couple of those tax regime is called, we refer it as Subpart F income and the global intangible low tax income, the GILTI. So the new measure introduced by the Act called the net CFC tested income, basically replacing the global intangible low tax income, the GILTI, that's more focusing on the active income earned by the corporations. The new rule will be applicable for any tax year ended after December 31st, 2025. So potentially some corporation may already be subject to it, given that we are already more than a month after the year end. Some of the change introduced is they removed the deemed return on the qualified business asset investment. Under the old rule, that a CFC is allowed to get a 10% return on some of the tangible asset they invested into the business. And if your income or your active income is within that 10%, they deem that there was no guilty tax would be applicable. But under the new rules, that the Q buy would no longer be a factor. There was no longer a deemed return on it. It also changed the ownership requirement. Previously, you have to be owning shares of a CFC at the end of the tax year. Now it changed it to be as long as you own it in any day during the tax year, you would be still required to be reporting your prorated net tested income earned from that CFC. So it's much more broader at this point. And also previously, if you are a corporate US shareholder or for certain individual shareholder with an election available in the code, you are allowed to claim a deduction equal to 50% um, of the tested income that would be otherwise guilty. Under the new rule, that deduction would be reduced to 40%. The same goes to the foreign tax credit allowed for corporate US shareholder or individual shareholder with election. Previously, the haircut is 20%. Now it changed it to about 10%. So I think giving all the change, what we see is a generally higher tax rate on any US person that would be subject to guilty or under the new regime called net CFC tested income. We expected that for you to fully offset your guilty tax either as a corporate owner or a individual shareholder utilizing IRC section 962 election, you would have to pay about 14% for a corporate tax rate to fully offset the guilty. Under the previous rules, the same requirement is only 13 and 1/8%. So it go up by less than 1%. As part of the change also as well that the downward attribution rule is limited. Previously under the old rule that if you even having a Canadian holding company with a US subsidiary alongside with a Canadian subsidiary, the Canadian subsidiary would may be treated as a control foreign corporation. That's what we at a really high level can refer it as a downward attribution. That rule is limited. Now the application will be much smaller, especially in the case that the U.S. entity would be end up in being a U.S. partnership or a U.S. trust. But that one is highly technical. We are not going to touch on it. It's up beyond the scope of this presentation. We could discuss it in a future presentation if possible.
Yeah, definitely a very technical piece. And if you're a US person that has ownership in a non-US corporation, you can definitely reach out to us and we can provide you some more in-depth information there if this applies to you.
Yeah, totally. And Paula, go back to you.
Okay. So we have a new gift return, IRS Form 708. So it's a new gift return, it's not a new rule. But Form 708 is for people who receive gifts or inheritances from someone who used to be a US citizen or a long-term resident and gave up their status, but is now considered a covered expatriate. So there's specific requirements or rules to determine whether or not you are a covered expatriate at the time you give up your status. And if you are considered a covered expatriate, or if a person gets a gift or an inheritance from a covered expatriate, the total amount that they receive, if it is more than the annual exclusion, which is currently $19,000, the person receiving the gift has to file IRS Form 708 and pay 40% tax on the amount that's over the exclusion amount of $19,000. So the key thing here is that the person receiving the gift or the inheritance is responsible for the tax, not the person giving it. So that's just something to be aware of. Again, this is not a new rule, but now this is a new return that the IRS just has developed to start documenting these gifts. And then in addition, Form 709NA, on the other hand, is for non-US citizens who do not live in the US, so non-resident aliens that are giving away US-based property. So for example, real estate or tangible items. If the total value of the gift to any one person in a year is again over that exclusion amount of $19,000, then the donor, so the person giving the gift, has to file Form 709NA and pay gift tax. This can be as high as 40% again. So usually the person giving the gift is responsible for the tax. If they don't pay, there can be some repercussions to the recipient. So it's something that you definitely need to be aware of. Philip and I are also we specialize in trust and estate planning, and we definitely try to steer people away from gifting real property if it's in the US, etc. There's definite planning that you can do to minimize the tax impact if you're have those assets and want to pass it on to somebody else. So again, just to recap, Form 708 is about the U.S. recipients getting gifts, and they have to file that form. And then 709 NA is for non-U.S. persons giving away U.S. property. And that brings us to our last polling question. So which situation requires the U.S. recipient to file Form 708, so 40% tax regime? Is it a U.S. person receiving a $300,000 cash gift from a covered expatriate, or two, a U.S. person receiving a $300,000 gift from a non-U.S. parent who is not a covered expatriate?
So I think Paula, I think gift tax or gift tax return is kind of a unique U.S. tax feature comparing to Canada, right? Canada, we don't have gift tax concept, but now it seems the U.S. just have so many different type of gift tax that could be applicable.
Yeah, no, that's definitely an area where the two countries are very different for the it's this type of this and also estate planning too.
Yeah, and one of the thing that we didn't mention is there was also the Form 709 that is for U.S. citizen or U.S. domicile making a gift. That one's not a new form, so we didn't touch it. So you could imagine now we have 708, 709, 709 NA forms. They are all covering some sort of gift.
Right.
Okay, so we hear back from our audience. 76% of our audience get it correctly that the correct answer would be the first one. A U.S. person receiving $300,000 cash gift from a covered expatriate. The second scenario would not be subject to 70A filing, but in that case, let's say that if they are gifting U.S. cited asset, then the parent may still have to file the 709 NA. Which we definitely need more detail to make that determination.
Yeah.
So that brings us to a lot of the new tax updates in both Canada and US. So we're gonna also kind of revisit some of the hot topic that we have seen so far in the recent time period. That a lot of the client come to us discussing about the Canada-US relocation due to various reason, family, political, tax reason. Those is a important topic because a lot of time when you're changing your residency, it creates a different tax implication either upon you cease or leaving one country or moving to another country. We would typically worry about the asset tax, whether departure tax of Canada, or you want to give up your green card or your US citizenship. There was the expatriate tax. That's part of the question related to whether you would be a covered expatriate. And also the residency would be a main focus for us because residency determines a lot of the tax implication for various income and also how to navigate the residency requirement between Canada and US domestic law with the consideration of the treaty, how to tie break between the two countries. The next item is we also touched on it a little bit that how's the cross-border tax treatment of registered account. Some of them we even discussed today that some of the example including the first home saving plan, saving accounts, the Trump accounts, or some of the older ones, maybe a TFSA, Roth IRAs. They are going to be treated slightly differently in the domestic country where they set up versus the foreign country. In the case for, let's say, a US citizen living in Canada or moving to Canada, or Canadian having those accounts moving to the US, right? We want to make sure that the correct advice was provided for those accounts and make sure they are not subject to double taxation, which is leading to the next hot topic of how to avoid the double taxation within the treaty. Um, the Canada-US treaty is typically pretty effective on eliminating those double taxation, except some of the more special circumstance that we're dealing with those registered account, or we're dealing with a corporate ownership or hybrid entity ownership. The common one would be an LLC, a limited liability company, or a ULC in Canada. So depending on the client situation, they might be subject to double taxation, even though the treaty is pretty comprehensive and pretty effective. We want to make sure that we understand the client's overall situation and providing those plan ahead of time, make sure they are aware of what's their exposure and try to eliminate those shortfalls.
Yeah.
And then the last one is estate and gift planning, complexity for cross-border family. A lot of them, uh, due to the people movement, that the family, the second generation, third generation, may be no longer in the country you are at. A lot of the strategy that commonly used for estate and gift planning in the domestic country setting will no longer work in favor of those beneficiary that is already overseas. And also, like Paula's slide, that it covers different gift exposure, gift tax exposure. That's something that's also really common and could be potentially pretty punitive.
Yeah, Philip, I was just going to say, if you are considering relocating from Canada to the US or US to Canada, I think the key is really to be proactive, not reactive. Set up that consultation call with your cross-border advisor. We do consultations like that ourselves, and where somebody can just really go through your assets and your income streams and make sure that you're aware of all the implications of your holdings and how the tax is going to be different.
Yeah, exactly, Paula. You already kind of teasing my next
Oh,
slide. The last one, the key takeaway is tax rules always changing, right? I think we gone through a major change on the US side last year, and then Canada just keep changing annually. A lot of the planning that was probably previously put in place may no longer be may valid. So we encourage the taxpayer or our client to continuously reviewing the tax plan, making updates based on the tax law change or some of the facts change, right? Because people or capital just keep moving across the border either side, business
mhm.
expanding, families moving to the other country for various reasons. Those plans that you put in place 10 years ago may no longer valid or may not serve the purpose.
That's right.
The last is, I think, the most important is you want to make sure you get the proper tax planning ahead of time. The timing is key that if you are planning a major change in your life, get the tax planning as part of the to-do list as well. Get it done ahead of time because sometimes once you already move to the other country or you already implement certain transaction, the opportunity is already gone. There could be only so much can be done to it when the transaction has been finalized. So that brings to our conclusion to our presentation. So after the webinar today, you will receive a survey from us. Please tell us how we can improve and some of the topic that you would like us to cover in any future webinar. Now we will stay for question that asked through the chat. And thank you for attending our webinar. Hopefully you would come back for more.
Thanks, everyone.
And then just also putting up our contact information. You could scan the QR code on the screen for any question that you may have in case we didn't have chance to answer those questions during the presentation today. Paula,
Okay.
do you mind pulling up some of the Q&A questions?
Yeah. I think that there was one question here on capital gains. And do you need to pay capital gains if I'm a Canadian and sell my condo in Florida? So yes, as if you are a Canadian resident, you are subject to tax on your worldwide income. So that capital gain would be subject to tax in Canada. And because that is real property situated in the US, you would also have a non-resident, if you are not a US person, I'm making an assumption it's here, US federal filing as well. Florida doesn't have state tax, so there wouldn't be any state tax. And also, you should be aware that if you are selling a US property, again, I'm assuming you're not a US person, that there is, as FERPTA, there's withholding that's required to take place on the proceeds as a non-US person. So generally, there's a percentage of the proceeds that will be withheld, and then you can claim that as a on your U.S. tax return as part of the tax payment, or there is a way to file an application to have that reduced. It is a bit of a process. We do help people with that. So if you're in need, you can reach out to us.
Okay, I'm going to read one of the questions from the chat. Is there a gift tax implication on this Trump account? For example, contributed by grandfather? I believe there would be a gift tax implication that any contribution made by the grandfather into the account would be considered as a gift. But go back to the contribution limit. It's only $5,000 per year. Let's assume that the grandfather only make a $5,000 per year basis. That it would be under the annual gift exclusion of $19,000. So even though it's a gift, because it's under the threshold of $19,000, the grandfather would not require to file any gift tax returns. And then
Um,
there was another question on the charitable donation. If you don't have income from US in the year, your charitable donation to US church, for example, cannot be a tax credit against your Canadian income, correct? That's more specifically on the Canadian requirement for charitable contribution credit. Is limited to 75% of the income sourced from that country in case that you're making a US contribution. The fact that you mentioned there was no US source income in the year, your 75% of US source income would be zero. So any contribution to a US church would not be able to claim on the current year and could be carried over to the years that when you start having US source income and still subject to the same 75% limit.
there's also a question here, is the $19,000 only for gifts regarding expatriates? No, the $19,000 is an annual exclusion for gifts. So each year it increases with inflation, and no, it's not. It's for gift any gift to another person in the US.
Yeah, with the only exception is if you're making a gift for your spouse, and that spouse would be subject to a different rule. If the spouse is a U.S. citizen, then you are allowed to give unlimited amount of gift to the U.S. spouse. But if the spouse is not a U.S. citizen, then the annual gift limit would be $190,000, which is 10 times of the regular annual exclusion limit.
That's right.
So the 19,000 or 190,000 is also commonly used in case that we have a client that have, let's say, the U.S. taxpayer that have more wealth and looking into strategy of lowering his wealth or her wealth and avoid the estate tax exposure. We could potentially encouraging him to making give over his lifetime, basically $19,000 for every recipient or $190,000 to his or her non-U.S. citizen spouse.
There's just a minute left. I'm just wondering if there's a quick one we could quickly answer, but might be running out of time here.
Does the 40% tax apply if the recipient is staying in Canada? I assume that 40% you're referring to is the 40% for gift receiving from covered expatriate, and the recipient, it would be a US person in this case, but living in Canada. The answer to that question is yes, as long as the recipient is a US person, whether US citizen, US green card holder, regardless of where they live, and they're receiving a gift from a cover expatriate that is over the annual um, gift limit of $19,000, then the recipient would be subject to the 40% tax regardless of their residency.
If we didn't get to your question today, please reach out to Philip or I. We'd be happy to assist you.
Yeah, I think that's bring it to the end of our presentation or webinar. Thank you everyone for attending. Look forward to seeing you in any of our future webinar.
Thank you.
Thank you. Bye.